All right. Good morning, guys.
Good morning.
This is Stephen Thomas of Refine Realty again. By myself, Michael, the astute home advisor, had family emergency, so he won't be joining us today. However, got a special guest, our new preferred partner with Caliber Homes, Mr. John Muhammad. He's going to be talking a little bit about the home buying process and how you go about getting the mortgage price. I know we've talked about how we are affected on the real estate side for the last couple of weeks, but I wanted you to hear straight from the horse's mouth about some of the things that you can do to prepare yourself now to be able to be approved for a mortgage. Some of the things that you can do now as you're preparing yourself in the next 6 to 18 months to be prepared to be in your next home. So we're going to talk about some of the processes, some of the pitfalls, things like that. So like I said, again, we're always trying to give you as much free game as we can when it comes to getting you into your next home. So without further ado, I'll let John tell you a little bit about himself, and then we'll get into it.
Thank you, Stephen. Good morning, everybody. Give you a little bit of information about myself. I've been in the mortgage business since 2002. Have learned a whole lot. I would tell you that I'm a specialist when it comes to down payment assistance, a VA loan, conventional loan. We just have so many different products. But I work with a number of buyers over the last couple of years, so we have a lot of experience. I hope to be able to share some information that'll help you this morning.
Good. So starting off, over the last couple of weeks, me and Mike have been talking about what to prepare yourself to be at when you're looking, when you want to be in a home and you're in your lease, you're 6 to 9 months out of your lease. Where do you start? I know we have a general idea as real estate agents, but like I said, you're in on that side. Every day. So what do lenders and underwriters look at, or what are the things that could help you get started?
Gotcha. So what I would tell you, folks who are looking to purchase anytime within the next really 6 months or a year, 2 years, whatever your time frame is, think about things from 3 categories. First, income, second, assets, and then credit. So income, you have to have consistent income. And what I say about that is it must be verifiable income. This must be either through the form of a paycheck, or if you receive a 1099, maybe you're self-employed, but everything has to be verified. Sometimes I talk to clients and they say, well, I do hair on the side, or I, may do yard work on the side. But if you're not showing that or claiming taxes on it, we cannot use it. So think about income. So typically, you want to have 2 years of income, at least 2 years of work history, okay? And so we can talk further about that. But assets, something else that you must have is money. I have some down payment assistance programs that we'll talk about today that maybe cover all of your down payment and closing costs. There's some out there like that right now. However, you'll always need money for earnest, meaning you put something up when you sign a contract to let the seller know you're serious. The second thing is you'll need money for an inspection, and you'll need money for an appraisal. Always save money and save it in the bank. Do not save your money at home. Saving your money at home is like not having it. Okay, we cannot use money that's saved in the mattress. So if you've got money, lenders will always look at 60 days or 2 bank statements. We look for large deposits that are greater than 1% of your loan amount. So if you're buying a house at $200,000, if you have a deposit greater than $2,000, we need to know where that came from. Right. So save everything in the bank. Credit. You can buy a home with a 580 score. There are some lenders who have loans at 500. You may hear these types of things on the radio, but keep in mind, anything under 580 requires 10% down. 580 gets you in the game. It's not a guarantee. But if you want to use down payment assistance, you need to be 620 or higher, okay? 620 or higher. So think about those 3 things: income, assets, and credit.
Gotcha. So I want to talk a little bit more about assets.
Yes.
Is there always money in the bank? do they have to have money in savings account, or could they look at the alternatives, like maybe having funds in 401ks?
Absolutely. Good point, Stephen. So you can use your 401k. A lot of people choose to do that. You can get a gift from a family member, very close friend. They can gift you the money you need for down payment or that you need for closing costs. We just ask them, if you do a gift, we've got to get one bank statement from them. So sometimes you want to make sure your family is comfortable with that. If you're using a 401k, check with your 401k provider. You should have two options. One would be that you can pull the money out as a hardship. They typically hold back 10% for taxes, and they just give you what you need with the contract. Second way you can do it is get a loan and pay yourself back interest over a said term, such as 5 years. So you don't always have to have your own money. You can use others' money, or you can use your savings.
Gotcha. Also going to the asset piece where you're saying banks look at what's going into the account.
Mm-hmm.
The reason why I want to touch bases on this a little bit is because I've seen it happen to me and some of my clients before, where they are getting help from family members, or for instance, there's a car payment that they've co-signed for, and the mother receiving funds from the daughter to pay for that car. It's actually her car, but it's in her name.
Right.
But she's receiving a cash payment from her daughter for the car.
Yep.
That would be a problem because, again, you're taking cash funds that cannot be verified.
Correct.
Okay. Cannot stress enough the verification process.
Mm-hmm.
So anytime money is coming into your account, they have to be able to find out where that money came from.
Correct.
Okay. And it has to be matched within a day or so of each other. So if you are receiving a gift, like he said, they're going to want to look at the person that's giving that money and look at their bank statements to make sure that, say, $5,000 that they gave you came out of that account and is transferred directly to you.
Right. That was a good point. And I'll say this too, because you hit on two big things. Co-signing. And, a lot of times we have to help friends and family members, and we co-sign, and we help our children get vehicles and things like that. If under FHA guidelines, which is typically going to be for somebody who's under 680 credit score, if you co-sign for someone, we really cannot overlook that debt if we're using FHA. However, on the conventional side, if you have co-signed for someone, or if they're paying the car note that is in your name with 12 statements, bank statements, or verification that they have paid those car payments or credit, whatever it is that you co-signed or that they're paying for with 12 payments, we can ignore that on the conventional side. So every situation is different. We will do our best. But if you're looking to purchase a home, don't co-sign for anybody right now.
Yes.
Don't buy anything until you get a home. Don't go buy a car for yourself until you get into a home.
Yes. Want to talk a little bit about the credit piece, not necessarily credit scores, but more on the debt to income ratio, or DTI, as we talked about a couple of times. Talk about some of the things that pull away from the DTI, like how student loans are looked at on both sides.
Yes, student loans is a big issue in a lot of communities. Student loans is a big issue. So if you're doing an FHA loan, again, which is the way that a lot of people get into homes, because they have a lower credit criteria, they have a higher debt to income ratio allowance. So FHA becomes a way. So FHA looks at it this way, and for everybody who may have a student loan, what most of us think is, hey, it's in deferment, it's going to be forgiven, I don't pay that, so we just think, okay, then that's out of the way. But with FHA, it is not. FHA figures that over a 30-year term that you're going to have this mortgage, at some point you would have to start repaying that loan. So their simple calculation is 1%. You have $100,000 in student loans, they tell the lenders to calculate that at $1,000 a month. Mm-hmm. That affects your debt to income ratio. There is a way to deal with that, and I'll hold that to myself. I'll tell us for our clients, right? But there's some things we can do maybe to get it lower, all right? On the conventional side, which is conventional is typically 700 plus, well-qualified borrowers who have a low debt to income ratio, where I've had clients that have $200,000 in student loan debt. But if your credit report shows that your payment is zero, or maybe on that $200,000 student loan that your payment is $200 a month, conventional allows us to use what's on the credit report. Again, another reason why it is important to get your credit score as high as you can, because the higher your score, the more options you have.
Gotcha. Okay. I want to dive a little bit deeper on the debt to income ratio and how that affects how much home you can buy.
Mm-hmm.
So my credit score up so I can get a better rate. How does credit score affect with rates and things like that? Is that a, you know, somebody that comes in at 600 compared to somebody at 640?
Mm-hmm. So I would say that credit score affects your ability to. Just trying to. We lost.
Maybe so, but we're good.
Okay.
We're live.
All right. So credit score could affect your ability. Like if you're at a 600 credit score, you can still get a loan, but you may have a harder underwrite. Gotcha. Right? It's going to be. You may ask for more documentation. You may need reserves. There could be some things that you need to do per the underwriting standard. But what I would also say is the law protects you. When your credit score is under 620, believe it or not, you would probably end up with a rate as good as somebody with the 660, 670 because of the high price mortgage laws. 620 and higher, you're gonna typically have to come in with just W-2s and pay stubs and bank statements. It's an easier way, but the higher your credit score, the better. Also keep this in mind with down payment assistance. A person can have a 620 score or they can have an 850 score, which is a perfect score. You're going to get the same interest rate because when you're using down payment assistance, it's about fairness. So the organizations that give the money want to make sure everybody gets the same deal.
Gotcha. Okay. Let's dive a little bit deeper in the credit side. How do charge-offs affect credit scores, and how do banks look at those when you're trying to get a loan?
Yes. Charge-offs typically, charge-offs are like this. I see things that I see charge-off a lot is car loans, maybe past repossessions. When a company takes a charge-off, they're basically saying, hey, we cannot collect this money from the person who owes us. Therefore, we're going to take a tax loss. We're going to take a loss against our taxes. And so that creditor does not get the benefit of taking the loss and basically counting that against you. So what happens is I'm able to ignore charge-offs. But I want to give you an example of a collection. Let's say that somebody has an $11,000 collection account that is for a car that you lost. The rules tell us that we have to use 5%. So that person would be paying we'd have to use a $550 payment against their debt to income ratio, which is for a car that they no longer have and may not have had in 4 or 5 years.
Gotcha.
So that's the way it is. But we can ignore charge-offs and collections. As long as your collections don't equal greater than $1,000, we don't have to count it against you. And medical collections, I've had clients who've been in bad accidents or have some kind of life-altering experience, and they've got thousands of dollars of medical collections. Well, we don't have to count medical against them.
Very good, very good. So I know you mentioned down payment assistance, and I know a lot of you guys see a lot of stuff about down payment assistance and what you can get and what you can qualify for, things like that. Why don't you talk a little bit about some of the things that you have at your company and also statewide?
Excellent. So down payment assistance, I would break it down to 2 categories. One, the 2 categories are local and statewide. When you talk about Dallas County, Dallas City, Fort Worth, Arlington, Louisville, all of these cities have down payment assistance programs, but they are restrictive. They are more geared towards your number of people living in the house. They're going to have lower income limits and also what you'll see is they require a lower debt to income ratio, whereas the rules may say 56.99, but the city may say 43.
Mm-hmm.
So you have these local programs that are harder to qualify for. So my company that I work for, Caliber Home Loans, would have to approve you, and then the city of Dallas has to approve you. Dallas County has. So those are more difficult, time-restricted type of down payment assistance. The second type is the statewide, and there are 4. One called TSHAC, one is called Seth Gold Star, one is called Seth 5-Star, and then the other one, TDHCA, Texas Department of Housing and Community Affairs. They have income limits, Stephen, believe it or not, $97,000 you can earn and get down payment assistance in some cases. Seth, I think, is $88,000, but there's just different things. If you have a married couple and one person makes $80,000 and the other one makes $50,000, then you're disqualified. But if we do the loan just in the person's name that makes $80,000, if they can afford it, hey, we can do down payment assistance. So there are so many different options. It could be as little assistance enough to cover your down payment. And I'll say this, the less you take from them, the lower your interest rate. The more you take, the higher.
Right.
So what happens is I can get you as little as 3%, which will cover down payment, most of your down payment, or as much as 7%, which covers down payment and closing costs. So that's big. There are some restrictions. Some of them you never have to repay back. There are no restrictions. Then there is one that actually says you have to live in the house for 7 years or 10 years. And if you sell or you refinance within that 7 to 10 year period, you have to repay some of the money. And then there's one that simply says, we want the money back that we gave you at the end of 10 years. Or, I mean, at the end of your 30-year term or when you sell.
Gotcha.
A lot of options out there.
And like I said, even with that, on that, I can even get even more creative on my side on how we structure the contract. So I know I mentioned last week that I had a client that we closed on a house last week and she got money back. And it was a combination of the things that I was doing as long as well with the lender as well. So we have those things in place for you guys to help you get to your end goal. So I know we're going a little bit past the time I like to keep. So if you had one thing, one piece of advice for our listeners when trying to get approved for a loan, what is the most important thing that you will want to leave with them?
The most important thing is to believe that it's possible. And if you believe it's possible, I believe that it's possible, and we will work with you. But you have to know these things that we talked about: income, assets, and credit will come into play. Right. Work hard. I'll give you some information. There's a website and an app called myfico.com. It will tell you what your mortgage score is. A lot of times we're looking at Credit Karma and we're thinking that that's our score. That is your credit card score, and it's free because Credit Karma is working for Capital One and Chase and these other banks that they represent. So if you really want to know where you are and what your credit score is for a mortgage, use myfico.com. Be realistic with yourself, set realistic goals, and work towards it.
And one thing I want to piggyback on what he said is not be afraid. Get started. You may be 12 months or 18 months out, but the quicker you get started and the sooner you start working with a professional to get you and point you down the right path, the easier your process will be to get in your home. We can show you where you go. Even if you're at a 520 credit score, doesn't matter. Get with John, get with myself. Let's point you in the right direction. We can show you the things that needs to be done with your credit, with your assets, where you can possibly look at buying a home. Even though that may be 12 months out, we can point you down the right direction so you know exactly what to do, so you can stop putting off what you can have tomorrow. Yeah. Okay. So hey, just want to thank you guys for tuning in this week's episode of Finance Fridays. If you like the content, please like, comment, and subscribe. Again, this is Stephen Thomas with Refine Realty, where the advice is free, but the knowledge is priceless. See y'all next week.